Welcome, folks. As people are joining, I just want to kind of update you on the office hours for this evening. I've moved them to tomorrow in case you didn't get the email. So it's supposed to be 7 to 8 tonight, New York time. It's going to be 7 to 8 tomorrow. So if you have any questions about your project, the final exam, there'll be office hours tomorrow and day after. And in terms of the logistics of the rest of the week, it's things are obviously piling up here. It's coming to fruition. So first, we'll have class today, class on Monday. Obviously, we'll wrap up with the Monday class. I would need the numbers on your project. What you found is your DCF value, your pricing, your recommendation. So when you have those ready, you can go to the Google Shared spreadsheet and enter them. I'd really appreciate it. And on Monday, of course, we'll use that as a framework for essentially taking a journey through the entire class. Is there any questions before we start? Your final exam, of course, is 2 days after that, and I sent the details yesterday in my email, so take a look at the details. It'll be available, I think, for 16 hours that day. So because it's a 2-hour exam, I want to give you enough flexibility that you could choose to take it in the morning, the afternoon, at night, whatever works for you. Any questions before we start? Okay, so let's talk today. Today we're going to talk about the last piece of valuation. And today we're actually going to take a very different perspective on valuation. Let me explain. Up till now, when we value companies, we've taken the perspective of an outsider looking in, an investor looking at a company and saying, what's the value of the company? And when you do that, you face constraints. What are the constraints? If a company is badly managed, it chooses not to borrow money, there's not much you can do. You've got to build in those presumptions. You can expect them to change over time, but it's based on expectations. You can't act. Today, I'm going to put you inside a company, and I'm going to ask you a very different question than the one we've been asking so far. How would you increase the value of your company? What are the things you can do as the owner of a company, as the manager, to increase the value? Now, I don't know how many of you plan to be in consulting, but if your job is consulting, not investing, that's essentially your task, right? You brought it to a company, you're asked, what can I do to increase the value of my company? So we're going to look at the value from the inside out, and it's going to be much more aggressive. Aggressive in what sense? Well, if you tell me your company has too little debt, you know what my answer to you is going to be? Do something about it. Go out and borrow more money, increase your debt ratio to debt. If you complain about the fact that the return on capital is less than the cost of capital, but you run the company, stop complaining to me. You are the one who took the projects. Stop doing that. Try to take better projects. It makes valuation both more interesting and more intricate because you can now alter the levers that change the value of a company. So today I want to start in my start of the class test by talking about what are the things you can do to change the value of your company. So I'm going to start with a very simple question about actions that you see companies taking. And I'm going to list out a series of actions, and I want you to tell me whether these actions will increase value, leave value unchanged, or decrease value. Okay? So first questions are about value, not price. So let me emphasize that I'm asking about the value of the company, not the pricing of the company. What about a stock split? Aaron, what does a stock split do to the value of a company? Increase, decrease, or leave unchanged?
I think it leaves it unchanged.
And tell me why.
Because all you're doing is changing the number of shares available. You're not changing the intrinsic value.
In fact, to change intrinsic value, you've got to change the cash flows, growth, the risk. And how does changing the number of units do it? So stock splits, stock dividends, reverse stock splits, you're just dancing around. You're changing number of units. That can't affect value. Could it affect price? Right? Because it could affect the mood. Maybe a stock split makes you feel wealthier for no reason at all. You own twice as many shares. You say, I own a lot more shares. You're saying that makes no sense. Pricing doesn't have to make sense. It's built on mood and momentum. Neil, how about amortizing goodwill? Often you'll see companies impair goodwill, which is the right word today, which is they look at a past acquisition and they'll impair the goodwill on that acquisition. Could that affect value?
I would say that would increase value because your value was based on the goodwill as well.
Where was goodwill in your value? Right, you have cash flows, growth, and risk. Now, where was goodwill in your value?
But so suppose you buy another company, wouldn't you account for the increase in cash flows you will have based on the other company's patent or asset that comes in? That's your goodwill.
Which is true. So basically those cash flows are still there. All the accountant is admitting to is a past mistake, right? So because this acquisition happened 3 years ago, 2 years ago, the business has changed, your cash flow should already reflect it. Goodwill impairments basically reflect a past mistake. You're admitting to a mistake you made in the past. Congratulations, you're being honest about something you should have been honest about. But from the perspective of value, you already knew this. The change has already happened. You know they screwed up. You know how much money is wasted paying accountants to come in and reassess and impair goodwill? The reason I say wasted is, you know what happens when they actually impair goodwill? Nothing. Stock prices don't change because people said, we knew this 2 years ago. Why are you telling us now? Impairing goodwill doesn't affect value because it doesn't. You know, the only scenario where impairing goodwill could affect your cash flows is for a tax deductible. Then it could affect your cash flows, right? Because this is now a good thing. I can write it off, I can pay less in tax. But unfortunately, 95% of goodwill impairment has no tax consequences. You kind of see where I'm going, right? When you want to see the effect on value, you got to see the effect on cash flows, growth, and risk. If there's no effect on value. Companies sometimes change depreciation methods in their reporting books. You're saying, why would you do that? If you go from accelerated to straight line depreciation, you can make your income look much better. It's a little game that they play. That's good, right? Higher net income, higher earnings per share. But if all of that increase is coming from changing the depreciation method you used only in the reporting books, it has no effect on cash flows, no effect on growth, no effect on the quality of the company, no effect on value. In the late 1990s, companies used to issue what were called tracking stock. Basically, they would take their sexy part of the business. No, New York Times Online, tracking stock. Why? Because everybody was paying these big prices for .com stocks. And you're saying, look, I have a .com business too. Here's a tracking stock. The tracking stock did nothing. It didn't bring in cash flows. It didn't affect the growth. It didn't affect the risk. It changed nothing about the value. You're saying, but why do companies do it? None of these actions affect value, but all of them could affect the price. Do you see why? I changed my depreciation methods in my books. My earnings per share goes up. You have lazy investors who take a PE ratio and put it on the earnings per share. What can happen? The price can jump even though there's no good reason. I issue a tracking stock. People get overexcited. They push up the price of my company even though nothing has changed in my company. A lot of what passes for value enhancement in practice is really price enhancement. You're doing things to make the price go up, even though there's no change in value. So one of the things we're going to talk about today is, whether companies should embark on these actions knowing they won't affect value because they're trying to influence the price. Now I'm going to make you a CEO of a company. It's got 4 divisions. And I'm going to give you the characteristics, return on capital and cost of capital for each division. You're thinking about selling one of these divisions. The answer is going to sound like a slam dunk, but think through it before you tell me. Which of these 4 divisions should you sell and what's driving that decision?
So the decision is going to be driven by the cost of capital being higher than the return on capital?
Yeah, that makes it easy, right? What's the worst business you have here?
I believe D.
D. So you want to sell D. Is that, but remember this, when you sell D, why are you doing it? Because it's a bad business. So that part we all agree on. D is the worst division here. But you know what the effect on your value is going to be of divesting this business? When you divest this business, the people buying this business, they know it's a bad business too. Yeah, they can see how bad it is. You try to sell it, you're going to get a price that you're not going to get your money back. If you were able to get your money back, you'd shut this business down, collect the invested capital. It's going to be driven by what people are willing to pay for this business. So here's the irony. If your value change comes from what people will pay for this business relative to what it is worth to you, your biggest potential for increasing value is not in selling your worst business, It's in selling your best business. It kind of goes, it's almost counterintuitive, right? Because every CEO when they brought into a company, what do they do? Let's sell off our bad businesses. So Ford in 2009, guess what they sold? They sold off Jaguar Land Rover because it looked like a bad business. They sold it for nothing. It actually means that when you think about what to shut down, what to sell, what to continue, you've got to think about what other people will pay for it. And we're going to talk about divestitures and how they can affect value. And finally, I want to talk about buybacks. There's a lot of misconceptions flying around about buybacks. And this was on Google at $60 billion as a cash balance. It decides to do a $45 billion buyback. Now, most bankers, if you ask them, why should we do a buyback? You know, the biggest sales pitches, right? If you do a buyback, your price will go up. That's really why companies often do buybacks. But if you're an investor in Google, will this buyback increase your price per share? Or in general, are buybacks always good? Will they always increase the price per share? Or is there something else I would need to look at to make that judgment? David, what do you think? When does a buyback increase my, make me better off? When does it make me neutral? And when does it make me worse off?
I guess you're talking from the company's perspective?
From the investor's perspective, you're an investor in Google. You see Google announce a buyback. When does it make you better off? When are you going to be happy that they're doing a buyback? When are you going to be kind of neutral? You don't care. And when are you going to actually say, look, they shouldn't have done that?
I guess it depends on my view of the company.
Okay, so it's built on that. If you trust the company and you believe that they can find a use for the cash, you could say, look, this buyback, they're not wasting money. You might even say that no, there's a neutral effect. I don't care. For buybacks to increase value, one of two things has to be true. You either don't trust the company. Remember, we talked about trusting companies with your cash. If you don't trust a company with the cash, the instant you do a buyback, you're going to be better off as an investor because the discount disappears. The other scenario where a buyback could actually increase value is if you're an underlevered company. This won't work with Google because they have no debt. But let's say you're a company with too little debt. You're an 18% debt ratio and you need to be at 30. Then, for some of you in my corporate finance class, one way you get to the optimal is you do a buyback. And why does your value go up? Not because you did the buyback, but because you're moving closer to your optimal. You have a lower cost of capital. So there are scenarios where buybacks can increase value. There are scenarios where buybacks will do nothing for your value. And there are scenarios where buyback can actually destroy value. If you're a young company, you need this cash to grow, and you take it and do a buyback, you've effectively made yourself a less valuable company. So we're going to talk about all of those layers that go into value enhancement today. So let's go back to where I left you in acquisitions. Now we talked about the 7 sins in acquisitions, using the acquiring company's discount rate, the cost of debt subsidy. And I left you with, actually, I sent you this link to read up on my assessment of the AB InBev SAB Miller merger. If you didn't read it, if you get a chance, do read it, because nothing else will give you a framework of thinking through mergers. So let's set the table. AB InBev, when it announced its acquisition or potential acquisition of SAB Miller, was the largest brewer in the world, and SAB Miller was the second largest brewer in the world. Already, when they announced merger, the question was, what are antitrust guys doing around the world? Are they going to be worried about it because the largest brewer buys the second largest brewer? You're consolidating the business in a way that's never been done before. But what made this merger intriguing was AB InBev, because AB InBev is run, at least controlled, by a Brazilian group called 3G Capital. For those of you who've never heard of 3G Capital, it's this group that also did the Kraft Heinz merger with Warren Buffett. They have a reputation of being among the most ruthless cost cutters in the world. And they actually mean it. When they say they'll cut costs, yeah. In fact, they have a history in the brewery business. They bought this Mexican brewer called Modelo, and they managed to cut costs enough to improve it, to almost double its margins. So when AB InBev announced it was going to buy SAB Miller, people cut them slack and said, if 3G Capital is doing it, they must be doing it because they see value in this merger. But the stakes were high. They were actually paying a premium of $25 billion over the market cap of SAB Miller. The SAB Miller's market cap is $75 billion. They were going to pay $100 billion. So already you can see, not only does this deal have to be good, it has to be good enough to deliver $25 billion in value. So when the deal was announced, I started with the premise that this must be a good deal. It's AB InBev that's doing it. So I'll admit my bias up front. I thought I was going to find that the deal made sense because of the people doing the deal. So I approached this in 4 steps, and I won't go through every detail. So I asked about, what could the motives for this merger be? So if you look at the two companies, AB InBev, largest brewer in the world, with some of the highest margins of any brewer in the world. So they're among the most efficient brewers in the world, 32% margins, is buying SAB Miller, not a bad company, but its margins are only 20%. So its largest brewer buys the second largest brewer. The challenge is, can you come up with $25 billion of additional value? So to cut a long story short, the first question I asked is, maybe SAB Miller is undervalued. Maybe it's undervalued. Maybe its true value is 120 billion. People are making a mistake. So I first valued SAB Miller standing alone. Think of it as a status quo valuation. Nothing changed. What am I getting? The value that I got was about 51 billion. That leaves me a lot short of the 100 billion they're paying. So that can't be it. Then I said, maybe they think they can run SAB Miller more efficiently, do a Modelo in SAB Miller, cut costs, increase margins. Well, that got me up to about 60 billion, maybe even 65 billion. But I said, this still doesn't get me to 100 billion. So the final step in this process, I brought in what I thought were the synergies in this merger. By combining the two firms, you could do things you could not have done as standalone firms. And I came up with a value of synergy of close to 15 billion, which left me way behind the 100 billion. But my point is, when I approach evaluation, when I look at a merger, first step is value the target company with status quo. Maybe the reason for the merger is pure undervaluation. Very seldom is true, but if that's the case, that alone will do it. If that doesn't work, value the company with changes in the company, maybe better management, more efficient operations. Maybe that's the reason. It's control. So the motive is control. That's where it should show up. If that doesn't work, then you can bring in synergy. And if that doesn't work, there's only one reason left, which is stupidity. You just overpay. Don't rule that option out until you've looked at these variables. But look at that option. That's always a chance because, as I said, look at the track record of big acquisitions. That is more the rule than the exception. So I'm going to skip through. If you get a chance, read that post. In fact, the value that I get for synergy, 14.6 billion. My conclusion here was, I know the people doing this merger have great reputations, but I don't see the value here to pay a $25 billion merger. Now, this merger's had 5 or 6 years to kind of play out. You can go look at the history of SAB Miller in the hands of, AB InBev. But it kind of forces you to think about, why are people paying the price they are? What's the explanation? Is it undervaluation? Is it control? Is it synergy? And you have the tools now to assess each of those individually, because each has a separate aspect of valuation you're looking at. By bringing that in, you can address each of those separately. So let's talk about value enhancement. Remember I said, those 5 actions I described to you, I said, does it change value? Then I said, could it affect price? And I said, the 2 can give you different answers. Let me give you the results of two studies separated by about 6 years to illustrate the difference between enhancing value and enhancing price. The first of these studies was done in the late 90s, at the peak of the dot-com boom. In fact, the title of the study is Rose by Any Other Name, was the name of the paper. And what this paper looked at was about 60 plus companies in the late 90s that changed their name. You say, what's the big deal? Companies change their names all the time. These 60 plus companies changed their name in a very specific way. You know what they did? They added something to the end of their name. Think of the late 90s and you can get the answer. It's the peak of the dot-com boom. Here's what they did. They took whatever the name of the company was, they added .com to their name. And this study also focused on companies that changed nothing about their business model. So you were a waste disposal company before, you're still a waste disposal company, but you're now browningferris.com. Let me ask you a question. If all you do is change the name of, so take whatever company you're valuing right now, you just change the name of the company, and it's the same company, same cash flow, same growth, same risk. What have you done to value? The answer is absolutely nothing. But this study looked at what happened to the pricing of these companies. And guess what happened to the stocks that added.com? On average, their stock prices double. This isn't just a small change in price, double, because they added.com to the name. Many of these companies were really small companies. So the doubling basically they went from 200 million to 400 million. But changing the name, you say, this is great. Why have we been spending all of this class talking about cash flows, growth, and risk? We should be talking about what's a better name for my company. Well, to show you why focusing on a name can be dangerous, I'm going to take you to a second study. This happened 5 years later. So by now, guess what's happened? You're now in 2002. .com has lost all its glory. The .com boom is bust. People hate .com companies. So guess what the study focused on? Companies that changed their name. You know what they did? They took .com out of their names. And guess what happened when they took .com out of their names? The stock price climbed. So now .com, instead of being a good thing, has become a bad thing. You think this is absurd. This is so crazy. It doesn't matter. Pricing can be driven by actions that have no consequences, but the price can still change. I mean, today, if you're a company, you want to add AI to your name, you want to add a China in your name, it's amazing. You add the things that reflect whatever people are pricing right now. And that could increase your price. I want to focus on value enhancement, not price enhancement, because I really don't know what will drive the price of a company. Maybe adding a celebrity to your board of directors will increase your pricing. But from a value perspective, we know to change value, something real has to change. Like what? You either have to increase the cash flows you get from your existing assets, maybe running them more efficiently, or you have to increase the value that you get from future growth by either growing faster if you have good projects or growing slower if you're taking a lot of bad projects. Or you have to lower your discount rate by changing the mix of debt and equity, maybe using better debt. Or maybe you can build up your competitive advantages and lengthen your growth period so you can grow for longer. Cash flows, growth rate, discount rate, or grow for longer. Every value changing decision has to show up in one or more of those places. So here's what I'm going to do. I'm going to take each of those pathways and look at ways in which companies might be able to increase value and talk about the types of companies where this is the pathway that makes the most sense. So let's say you're hired as a CEO of a company. The company's had a tough 5 years, and you can think of whatever company you want to as your favorite company. You're now the CEO and you've been given a mission. No, this company's on the wrong path. You got to increase the value of the company. It's the first place you're going to look at your existing investments, right? Before you get ambitious about the future, you're going to look at what you're producing, what your costs are, what your revenues are. You're going to try to increase your cash flows from existing investments. So let's see what the things you could do. Maybe you can run your operations more efficiently, cost cutting, more efficient operations. That shows up where? It shows up as a higher operating margin, lower cost, higher margin. That's your first stop. Second stop, if you have businesses that are losing money that you expect to lose money forever, for God's sakes, shut them down. Don't even try to sell them. Just shut it down. You're saying, why wouldn't somebody already have done this? Because people hate to admit their mistakes. You started a streaming business as AT&T 4 years ago. You're losing money like there's no end in sight, and it looks like you'll never turn the corner. But if you're the CEO initiated that business, you're not going to shut it down, because the act of shutting down a business is an admission that you screwed up. You know that in behavioral finance is a study of investor behavior that shows that people hold on to losers too long. You know what I mean? Losers, you buy a stock and it goes down. There's clear evidence that people hold on to losers for too long. They let losers ride. You know why? Because the very act of selling that stock is an admission that you screwed up 4 years ago. Sounds completely irrational. But it's amazing how you cover your eyes. I don't see that stock. It's in your portfolio, but you deliberately act like it's not there. Same thing applies with businesses. You have a money-losing business. The CEO initiated that business, is not going to let go. So you know when divestitures usually happen? Is when the new CEO comes in. Because he has no trouble admitting to the old guy's mistake. That was a mistake. That was a mistake. That was a mistake. Clears the table so he can make his own big mistakes. Third, and this is going to sound mildly unpatriotic, but take it for what it's worth. I've never viewed it as the objective of any company to maximize taxes paid to the government. Maybe you see it differently, but I'm going to cover myself fully. Within the framework of the law, my job as management is to minimize taxes paid on my income. So I'm not saying break the law. I'm just saying there is a law here. You didn't write the law to the extent that you can. And let's think about the ways in which companies do this. It shows up as an effective tax rate being much lower than the marginal tax rate. If you're a multinational and you have the capacity to report your income in a lower tax locale, you're going to take advantage of it, right? There's a reason your Irish sub is the place where a lot of your income goes, if it's income that cannot be traced geographically. Now, Google tried to put YouTube in Ireland. They created a subsidiary that was Ireland-based for YouTube. The argument being, when YouTube collects advertising revenues from around the world, it's up there in ether space. We're just going to put it in Ireland. So if you're a multinational, you can move income to lower tax locales. But if you're a multinational, there's also this phenomenon called transfer pricing. You heard of transfer pricing? You know what that is? Anybody have a guess on? Brian? You know what transfer pricing?
Oh,
yeah, go ahead. Shreya, what is transfer pricing?
Yeah, so I worked in transfer pricing before Stone. And
my sympathies to you. But,
yes, I'm an accountant. So transfer pricing is it's a tax phenomenon that ensures that when multinationals trade with their subsidiaries and their related parties, it happens at arm's length, which is to say at fair value or market price. But I will confess.
If you were trying to explain it to your grandmother, that's not the way you would explain it, right?
Okay, so
transfer pricing is a way of rationally spreading income around the world because we're a multinational and you interact within the company. You know what I mean by one division sells stuff to another division. I am just the person who makes sure everything is fairly allocated around the world so each subsidiary is given benefit for its work. That's the way you describe it to your grandmother. But then if I caught you in an honest moment, you'd say, you know what, my job is to make sure that income flows from high tax locales to low tax locales. So in a high tax, when you have a division in a high tax locale interacting with a division of the low tax locale, I'm going to make sure the prices that I set for products will, as long as they pass this arm's length transaction, move income from higher tax to lower tax locales. Is this immoral? Absolutely not. This is the law. You're not breaking the law. Presumably, if you're good at transfer pricing, you're taking advantage of the law to move your income to lower tax locales. And I'm not being a great fan of risk management. I think companies manage risk too much, but sometimes one of the positive byproducts of risk management is by smoothing income across time, which is what risk management allows you to do. You might keep your taxes lower than they otherwise would have been. I'll give you an example. In the early 80s, there was this corporate tax designed specifically for oil companies because they were making a ton of money. And it was a supernormal profit tax. So if your income exceeded $1 billion, you had to pay this extra tax rate. And as you know, oil companies when oil prices are higher, income could be $1.5 billion. When they're low, it could be $500 million. So you know what oil companies started doing? Using forward markets to smooth out their income and keep the income at close to $1 billion and not have to pay the supernormal tax. So if you can find a way to, within the framework of the law, and let me notice I keep re-emphasizing the word, within the framework of the law to reduce taxes paid, in effect, increase the value of the company. So those are all things that, so in a sense, I'm looking at the variable tax rate. If you've overinvested in the past, live off the fat for a while. In other words, you created 300% capacity. It doesn't require you to pay. You don't have to keep putting money in CapEx if you have 300% capacity. What is living off the fat? You still get the depreciation. So this might be a valuation where, at least for the near term, depreciation is high and capex is low. Why? Because you can afford not to reinvest in the next 5 years. It's not permanent, but you can increase your cash flows. And finally, if you're a company in a sector where working capital is a drain on your cash flows, managing working capital better can increase your cash flows. I'll give you an example. Now, when I took my accounting class as an undergraduate, I was one and done, but I remember taking that accounting class. I was told that healthy companies maintain a current ratio of 2 to 1. The current asset should be twice current. I don't know who makes up this crap, but that became a rule, 2 to 1. And retailers used to follow this rule. Their current assets were twice current liabilities. And for retailers, this was a huge drain on work, because if your current assets are twice your current liabilities, remember working capital is the difference, you're setting aside huge amounts that are tied up in inventory and receivables, much higher than your payables. So retailers until the mid-80s, working capital was their biggest drain on cash flows. Until Walmart came along and they said, this is stupid. Why should current assets be twice current liabilities? Why can't we make working capital a neutral item? Forget about a positive cash. No, let's make it neutral. In other words, if we keep our inventory and receivables roughly equal to our payables, our working capital needs go down towards zero. And if we do that, think of how much our cash flows will go up. Hundreds of millions, perhaps even billions. So one of the innovations Walmart introduced, which is now state of the art for every retailer, is just-in-time inventory management, where essentially a person will go around the stores making sure on the shelves that you didn't have 15 items or 15 of one item and 3 of the other to keep inventory. That brought down receivables. They started squeezing their suppliers by saying, you know what, we're going to take 60 days to pay you. And if you're the supplier to Walmart, what bargaining power do you have? You take the 60 days. What does that do? That increases payables. In a sense, what they did was they brought working capital from this huge drain on cash flows to a neutral item. In the late 90s, Amazon took this to the very next step. They said, why make it a neutral item? We'll make it a positive cash flow item. But they actually made the payables higher than the receivables, and they actually lived off the cash flows and that they used it to cover them. So to the extent that you're in a business where working capital is an issue, managing that working capital better will show up as higher cash flows. Now, do you see, to decide what to do, you first have to look at who I made you CEO of. If I made you CEO of Bed Bath & Beyond, the places you're going to go to get higher cash flows are very different than if I make you the CEO of a manufacturing company. The manufacturing company would start at the factory floor. So what are we doing? Why are costs so high? How can we bring them down? With Bed Bath & Beyond, you're saying, what are we carrying? Why is our inventory so high? How do I bring working capital down? But the end game here is you're trying to extract more cash flows from existing assets. Any questions on the first step? Let's turn to the second step. Let's suppose that you look at your company and there's really no fat here. You really can't extract much more cash flows from existing assets. You turn to the second place you might change value. You look at the value of growth. And remember, the value of growth comes from how much you reinvest and how well you reinvest, right? It comes from that difference between the return on capital and the cost of capital. So let's take the more positive scenario. If you're a company in a good business where you're earning well above your cost of capital, but you're very conservative, you don't reinvest much, you know how you can increase value? You can reinvest more. Because you have all these projects, you're just turning them away. Why? Because you have some arbitrary hurdle rate you pick. We will not pick projects that earn less than 20%. Where did the 20% come from? God only knows. Your cost of capital is 8%. I'm going to push you to reinvest more. And if you want to get more specific and say, where am I going to reinvest? You can reinvest either in internal projects that make more than the cost of capital, or if you can, find acquisitions where you can earn more than your cost of capital. That's more likely if you buy private businesses. Remember, we talked about, but you're looking at a higher reinvestment rate here, pushing up the growth rate if your return on capital is greater than the cost of capital. But there's another scenario, right? I bring into a company, it's actually growing, but it's growing badly. What do I mean by growing badly? It's reinvesting a huge amount, but it's earning a return on capital less than the cost of capital. You know, the easiest way to increase value in the company? Just stop. Stop reinvesting. Nobody forces you to reinvest. Remember the Tube Investments valuation I did a few sessions ago, where the company had this high growth rate, but earning a cost return on capital well below the cost of capital. Reinvesting less there could be a pathway to value. So your second stop when you think about value of growth goes back to this comparison of return on capital and cost of capital and deciding what's right for you as a company, given what you choose to do. But as you do this, you got to be careful, right? Because you try to do something that you think will make you better off. If your competitors act in a way that is responsive to your change, you could all be worse off. I'll give you an example. I hire you as a CEO for an airline. You decide the pathway to growth is to cut ticket prices. And in your mind, you say, if I cut prices, I'm going to get higher market share. I get higher market share. That's going to make up for the fact that I have lower margins. Everything's going to be great. I'm going to have this high return on capital. And you cut prices by 10%. You know what could ruin your plans? All of your competitors also cut prices by 10%, in which case you've all become worse off than you were before because none of you gains market share and you all have lower margins. It's amazing how many corporate actions act like you're the only mover in the world and everybody else stays still. So let me give you some history on growth and where you're most likely to get value from growth. Because as I said, we often talk about growth as a good thing, but not all growth is created equal. So this is from a McKinsey study where McKinsey has this incredibly proprietary database of every company they've consulted for that they've tracked over time. So a lot of the McKinsey research is very unique. That data is not accessible to anybody else. So in this study, what McKinsey looked at is all the advice they'd given to companies about growth. And then they classified this advice, the growth advice, into 5 groups based on how much value was created on average by each type of growth. So from best to worst, over the database, over history, and this was over several decades, what they found was new product development had the biggest payoff. And the way they measured payoff is for every $1 million I invest in new product development, how much do I get in additional value? Their answer was about 1.75 to $2 million. That's a huge net present value. On average, new product development is the most lucrative way of growing. So you're saying, why should every company develop new products? It's also a very difficult pathway to have because for every new product that succeeds, there are 5 or 6 that don't. So if you're the one that succeeds, you get this huge payoff. It's a hugely skewed. So on average, new product development is the most lucrative way, but it might also be in terms of probabilities, the most difficult way to get growth. The next best was expanding an existing market. By doing what? By either finding new uses for a product. So for instance, when aspirin became this pill that people took every night as baby aspirin to keep, to reduce your risk of heart attacks, it expanded the market for aspirin pretty dramatically, a new use for the product. Or new geographies. Coca-Cola had become a mature company by the early 1980s. The way it found growth was it went global. So by either going geographically or finding new uses, you expand an existing market. So that's the next best. $1 million invested in that creates about 0.3 to 0.75 million in additional value. Maintaining a growing share in a growing market. So if you're maintaining market share, but in a market that's growing, not as good as expanding an existing market, $1 million invested creates between 0.1 and 0.5 million. And then you get to the 2 growth strategies historically that have not been that good. The first is competing for share in a stable market. You try to go for a higher market share. You will get the growth, but the payoffs become much dicier. And you can see why, right? To get a higher market share in an existing market, you often have to cut prices. You have lower margins. You get the higher market share. The net effect might actually be negative for you. So if you look at the payoff, there's actually a pretty significant percentage of the time that you actually get negative numbers, which means you invest $1 million, you get back only 0.7 million. And then you look at the worst way historically that companies have grown. And this should come as no surprise, especially after last session. Historically, the least lucrative way of creating value is to try to acquire your way to growth. And again, you get sub-slices, right? If you have a much better shot at private than public companies, but on average, acquiring growth has always been the most expensive way to grow, the one with the least payoff. Because somebody else did the dirty work. You're now jumping in, you save time, you save energy, but you're going to pay a price for it. So not all growth is created equal. Some growth is more likely to create value than others. And to kind of show you how much, how common it is for growth to destroy value. This is a graph you've seen before. I look at return on capital and cost of capital for individual companies, and I break companies down. This is global companies, the start of 2020. I have the start of 2021 numbers, but 2021 is a little odd because 2020 was such a strange year for companies. So I'm going to go back to you. So people can't argue that this was COVID related. Now I'm looking at the start of 2020, at 2018, 2019. And here's what I find. Out of the 40,000 plus companies globally, about 33% earned a return. So look at the very last row. 33% of global companies out of the 45,000 earn a return on capital that is greater than the cost of capital. One in three companies earns a return on capital greater than the cost of capital. Think of what I just said. The remaining 2/3 of companies earn a return on capital less than the cost of capital. Are they all bad companies? Not necessarily. Some might be in growth, some might be infrastructure companies. I'll cut all kinds. It might be commodity companies, commodity price went down. But a significant chunk of that 68% or 67% of companies earn below their cost of capital year after year after year. You become the CEO of one of those companies. Your fastest pathway to growth is to stop growing. Our fastest pathway to creating value is to stop growing. Because this is just a bad business to be in. So that's the second stop. Look at growth, look at whether it creates or destroys value. Any questions about the growth pathway? So the kinds of companies where this is going to make the biggest impact as a CEO is companies that are growing, but are not growing well. Either they're not reinvesting enough and they're good projects, or they're reinvesting too much in their bad projects. And as a CEO, your job is to be the person who shuts that process down. The third stop is to look at what the company can do to make its barriers to entry bigger. I'm not a strategist, thank God for that. But when I think about a company's competitive advantages, I can think of at least 4 broad groups that I can put these competitive advantages in. And these can either be new advantages or advantages you already have. The first is brand name. Let's not underestimate the value of a brand name. It's, we talked about the pricing power that comes with the staying, but we looked at Coca-Cola, 80% of its value came from its brand name. If you have a great brand name, preserve it, protect it, don't let it deplete. Remember, there are brand names that historically have been great brand names, now they're gone. Godrej in India, at one point in time, everybody who had a cabinet in their house was a Godrej cabinet. Today, you tell younger Indians, Godrej, this, I've never heard of it. Quaker Oats, at one point in time, is an amazing brand name. It allowed the brand name to deplete. It's trying to build it back again. So if you have a brand name, preserve it. And if you don't, work at getting one, right? You can see all these young companies are works in progress, trying to build up a brand name. The second is, if you can get protection from competition, do so. What's the first question you heard on Shark Tank after everybody's described the business? Do you have a patent? And there's a reason for that, right? Protection from competition is good, and you're looking for the protection. But be careful what you wish for. Once in a while, you might get protection from competition from the government, but in return, they will ask you to do things that might actually destroy more value than you gain from the protection. I'll give you an example. Until about 40 years ago, phone business pretty much everywhere in the world was a regulated monopoly. In the US, phone business was run by private companies. There was actually one company, AT&T, and then broken up into 8 phone companies, but they had 100% market share. They were a regulated monopoly. The monopoly part, you can see why, right? They own the phone lines. Without the phone lines, you can't have phone service. They control the phone lines, they have a monopoly. See, what's the regulated part? The regulated part was they were not allowed to set the prices for phone service. They had to go in front of a regulatory commission in each state, and beg for a price increase. You know how the Regulatory Commission decided whether they get a price increase? This is true for most regulated businesses in the US. They looked at your cost of equity and they looked to see whether you were earning more than your cost of equity. And if you were, you weren't going to get your price increase through. They basically said, if you're making more than your cost of equity, that's too much. We're going to make you price your products to earn your cost of equity. A lot of people have become very rich being expert witnesses for regulated phone and power companies, because these companies will pay you to tell the world that their cost of equity is really 15%. It's in your best interest to make your cost of equity as high as possible, because then you can get much higher price increases. But if in return for getting protection, I take away your pricing power, what have you gained? Everybody hates you when you're a monopoly. You know how you get back at them? You charge them a higher price. If I take away that power, you get the worst of both worlds. Everybody hates you because you're a phone company. You get no pricing power. Is this really what you want? A protected business where you get no pricing power? Third, and this is especially true in technology businesses, you want to create switching costs. You know what those are? You want to make the cost of switching into your product as low as possible. But once people switch in, you want to make the cost of switching out as high as possible. I want to ask you, how many of you have self-service? I'm sure all of you have self-service. Think of the sales pitch you get when you walk into an AT&T, Verizon, or T-Mobile store. What's the first thing they tell you? Oh, no effort. We can switch you in a minute. You're right here. You know, this moment, you keep your phone number. Just no. And we'll give you these great deals to switch it. Just come in now for the next 3 months. We'll throw in, I think T-Mobile is throwing in Netflix, and AT&T is throwing in as a free service. For the next 12 months, you get Netflix. And you've been too stingy to buy Netflix. Yeah, this sounds like a good deal. I can switch instantaneously. You switch, and then they give you this 15-page agreement in really small print, and you just sign it. You don't have to read it. And after you've signed it, they've got you locked in. For the next 3 years, you try to switch out, they'll make you pay $15,000 for your phone. But who can blame them if you had no switching costs? In self-service, you'd be switching like crazy. Within the course of one day, you'd go from Verizon for the first 6 hours to AT&T, depending on what part of the city you were in. So in businesses where it becomes too easy, you got to create stickiness. And it's not easy. I mean, it's a business, you know, it's what the ride-sharing companies have struggled with, right? There's no stickiness in that business. Now I have both Uber and Lyft on my phone. And until the virus, I used to fly out every Sunday night from San Diego. I'd take the red eye to come into New York to teach in the morning, Mondays and Wednesdays. So I'd come in at 5 a.m., I'd land in New York Airport, and now I'm definitely not getting into a yellow cab. That's not even in my realm of choice. I'm looking to see whether I should take Uber or Lyft. You know how I pick? I entered my destination, entered Uber, it gave me a fare. I entered Lyft, it got me a fare, and I picked the one with the lower fare. What do I care whether I take Uber or Lyft? I don't. This is often the same guy driving for both services. This is a business with no stickiness. And to me, that's always been the weakest link in the ride-sharing business. It's a business with no stickiness. And they know it, and they're trying. Do you know what Uber is trying to make this model more sticky? Anybody have any guesses? I mean, ride-sharing companies want you to stay on as a customer. So one is they're trying to, go ahead, Courtney, what are they doing?
Adding other partnerships, such as like Marriott, I think, hotels, creating stickiness with other brands that have brand recognition.
In fact, American Express gives me $15 Uber every month for free. There's nothing free, but as part of my $15. That's Uber's partnership with American Express saying, you know what, let's try to make this more sticky. They tried to have a subscription model because that's the other way you can make it stickier, right? If you pay $150 a month, then you can take as many Uber. That didn't work because it turned out that the people taking on the subscription, the places they tried it, were the people who normally spend $600. I'm surprised they don't use data more. Maybe they do, and they haven't figured out how to do it well. If they know that you always go from point A to point B every morning, and they have it in the system that you've done it, maybe there's a way in which they can not only build this in, so you don't have to even try. You just have to go to work and they already have the car waiting for you outside, because at 8 a.m. every morning, that's what you do. They try to use, so these are all things they're trying to do to make the model more sticky, but right now it's still not working. I'm still testing Uber and Lyft and picking the cheaper one. I'll know the model has become stickier the day that I pick an Uber ride over a Lyft ride, even though the Uber ride is $3 more expensive. As an Uber investor, I'd like that to happen. As an Uber rider, I don't think I want that to happen, but that's a stickiness, switching cost. And finally, if you have a cost advantage as a company in the way you produce, that's a huge plus for you, right? There's a reason Saudi Aramco is valued the way it is. It's not because it's run by the most efficient managers in the world. It's not because a great project, because it's because they have access to 300 million barrels of oil under the sand in Saudi Arabia, and it costs, what, $4 a barrel to get that oil out, whereas the typical oil company face costs of $20 to $25 a barrel. That cost advantage is almost insurmountable. So one of the first things to think about is, what are the competitive advantages I have as a company, or so if you're the CEO of a company, what are the competitive advantages we have? How do we preserve them and grow them? And what are the new competitive advantages we can seek out? So cash flows from existing assets, value from growth, barriers to entry, competitive advantages that allows you to grow for a longer period and make more than your cost of capital. Last up, I'm going to ask you, is there something you can do to make your discount rate lower, your cost of capital lower? And your answer is obviously. The one that comes to mind almost instantaneously, if you're a company with no debt and 100% equity, and your optimal debt ratio is 20 or 30%, say, let's just go to the optimal. So one thing you can do is to try to move to an optimal, because the whole idea of an optimal debt ratio is it minimizes your cost of capital. But that's only one of 4 ways. Here are the other 3. If you mismatched your debt to your assets, you know what I mean by mismatch? If you borrowed rupee debt to fund dollar assets, or dollar debt to fund rupee assets, short-term debt to fund long-term assets, just stop, because it's increasing your default risk. Matching up your debt to your assets reduces your default risk and your cost of debt, and by doing so reduces your cost of capital. So it's 2. You're saying, what are the other 2? Remember when we talked about betas, we said the beta of a company is driven by how discretionary a product or service is. That if something is discretionary, it's more likely to have a higher beta. If you can somehow find a way to make your product or service less discretionary, something people need to live, you in effect lowered your beta, reduced your cost of capital. There was a time when cell service had a very high beta. Why? Because you didn't need a cell phone. 20 years ago, you could live without a cell phone. Only people who walked around with Blackberries were people who were far too important for their own selves. Let's face it, you could. Today, without a cell phone, you probably don't even know where you live, what your name is, who you're married to, when you were born. You just have to check yourself on, what am I, who am I, where do I live? Let's face it, it's become non-discretionary, which effectively means you lower the beta for your company. So the more companies add to their services to make it things that you cannot live with, the bonus they're also getting is they're lowering the beta for the company. And finally, if you have a lot of fixed costs, remember fixed costs increase your beta by making every shock to your revenues even greater. If you can bring down that fixed cost as a percentage of your total cost, by doing what? Maybe by outsourcing. I mean, this is a rationale. When you outsource a fixed cost, you in effect have made it a variable cost. You lowered your beta, you lowered your cost of equity. So when people think about how can I lower my cost of capital, they think about the debt ratio and then they stop. My advice is go on. Do I have the right kind of debt? Is there a way I can make my product or service less discretionary? Can I reduce my fixed costs? All of which show up as a lower discount rate. Everything you see out there as a restructuring has to show up somewhere, right? It has to show up in one of those 4 places. Kushal?
Professor, I apologize if you're going to get to this later, but the 4 steps, are they in order of how management should focus? Because I'd assume the decrease in cost of capital is probably not something that crosses the mind of.
It'll depend on the kind of company I call you into. If I call you into a technology company that's struggling, let's say it's VMware or a gaming company, you're not going to start with existing assets because they don't have much. It might be that your primary focus is going to be in the value growth because that's where you're going to make or break this company. The cost of capital, there's not much room to run. It's a technology company. There might be no brand name. So you might say, look, I'm going to focus on the value growth. If I bring you into a manufacturing company that's been around 100 years, it's in a mature business, there's really not much for growth. The place you're going to focus on is increasing cash flows and existing assets and the debt ratio, because it's a company we're changing the mix of debt. So I think it's rather than think of them sequentially, you're going to think about the company you're in and where your greatest chance of creating value is. And you're going to go there first. Doesn't mean you ignore the other three, but that's going to be your starting point. And then you're going to go out from there and say, is there something else I can do? Maybe even with a technology company, there are ways you can make your product to service less discretionary. Remember, a lot of software companies have gone from selling software and making their money on upgrades to a subscription model. A subscription model has a lower beta and a lower cost of capital than a model where you, so there are things which are subtle that you can do at the operating level that can lower your cost of capital. But your starting point is going to depend on the company I make you CEO of and say, change this company. So if you were the new CEO of GameStop, where would you start? And you can already see the challenge with the GameStop is you can view them as a retail company and say, our job is to cut costs, but guess what? There's not that much room there to make money. You can cut costs, but the business itself is shrinking, brick and mortar. So you might say, look, my real value here comes from online sales and creating a platform where people can gain. And maybe there's a way I can get more value from growth by doing that. So really, I think the best way to think about this, pick 5 companies that are in the news for being in trouble. And with each one say, with this company, where would I start? And then where would I work from, given what I know about this company? So let's take an example. Let's assume that you're going to value a company. So, Kushal, you can stay on because you're now going to become the CEO of SAP, German software company. It's a very un-German company. It's a very innovative growth company. And this is a valuation I did in 2005 of SAP. So I'm going to take you through my status quo valuation. Remember, this is the previous CEO doing it. And the question you got to ask is, if I were made CEO of a company, where am I going to start? So this is a company that has pretty hefty operating margins. How hefty? Much higher than the industry average. File that away, because what am I telling you? There's not much room for efficiency growth yet because they're already pretty efficient, delivering high margins. They're reinvesting a fair amount, 57%, and making tremendous returns on capital, about 20%. That gives them a growth rate of 11.4%. They're funded almost entirely with equity right now. Why? Because the existing management absolutely hates debt. They don't want to borrow money. So they're a pretty well-run company with blind spots. Their blind spots are that they don't like to use debt. They grow almost entirely in the US and Europe. They don't like Asia because it's too uncertain. They don't want to go there. So the reinvestment rate and growth rate reflect that. And I make you CEO of the company. But they're also earning a margin much higher than the industry average. You know where you're going to start here, right? You're not going to cut costs because really it's a company that's already delivering margins above the average. If you're going to change this company, the first place you're going to start is how much can it afford to borrow? There's no debt. What can I do? And the answer is it can't afford to borrow that much money, but it can go up to about 30% debt. Their cost of capital can drop to about 7.95%. They have the capacity to borrow money, even though they haven't. Before you jump to a higher debt ratio, you need to do this. In fact, what I've done here is what I do in my corporate finance class when we talk about capital structure. To decide what the optimal debt ratio for a company is, you got to play it out. At every debt ratio, you got to figure out what your cost of equity will be. And remember, as your debt ratio goes up, your beta will go up and your cost of equity will go up. And as your debt ratio goes up, you also have to think about what your cost of debt will become. Because remember, your current rating might be AA or AAA, but you have no debt. But you go to 20% debt or 30% debt, your rating is going to decrease because there will be more risk in your company. You got to walk in with open eyes. You can't just change the debt ratio, everything changes. And in this case, there is some potential for using debt. File that away. So as CEO, you could come in and borrow more money. And as I said, this is a company that has been pretty aggressive about growing in Europe and in the US, but has stayed away from Asia. But that's where the future might lie in terms of growth. So maybe you can find a way to reinvest more money. I don't know enough about the business to know whether it's realistic, but let's say you could. Right now, your reinvestment rate is 50%. If you can increase that to 70%, directed towards Asia, your growth rate is going to be higher. You have a higher, your cash flows will be lower, but your growth rate is going to be higher. So instead of growing at what was 11.44%, you can now grow at 13.99% by reinvesting more. And if you can move to a 30% debt ratio, you'll end up with a lower cost of capital. So in this case, there are two things you change about the company. The way you're growing, you get more aggressive in your growth, and the way you're funded with this, you get more aggressive with that. With those two changes, the value per share I get is 127 euros per share. If you want to compare that, the value that I got with the old management running, the conservative management that didn't use debt and didn't like Asia, was 106 euros per share. With you running the company, making the changes that I put in. And I know it's easier done on a spreadsheet than in practice, because I mean, that Asia investment is going to come with a lot of upfront costs. You got to hire for, for a new region of the world. So I'm not saying it's going to be easy, but if you can pull it off, you can increase the value from 106 to 126 because you've funded the company more efficiently and you're being more aggressive in seeking out good growth. Here's a very different example. You probably all read the stories about the last Blockbuster video left in the country, right? There's one in Oregon or Washington. It's the last one. It's kind of a museum piece. But there's a time not that long ago when Blockbuster was one of the fastest growing companies in the retail / service space. And Blockbuster took advantage of the fact that people had video players, they wanted to watch videos, and they were a video rental place. They were opening, I think, 150, 200 new Blockbusters every year through the 1990s. Huge growth business, tremendous margins, market caps soaring. And then Blockbuster got hit by two challenges that they never quite overcome. One was companies like Walmart started putting these red box rental things outside. It's almost like a rental where you could just pick the movie, put in the money, and you could get it for $1.50 instead of paying the $4 or $5 that Blockbuster was charging. So they got hit by, and Walmart didn't carry thousands of movies. They just took the 50 most widely watched movies because they knew that's what people were wanting to rent over and over anyway. They counted for 30, and they built a business around renting those movies at a really discount price. So that hurt Blockbuster. And the other, of course, challenge was, does anybody remember what happened in the early 2000s? Netflix. Was the first coming of Netflix. The way, if you don't remember how Netflix, most of you are too young to remember, the way Netflix used to work is when you subscribed, they would actually mail you the videos in an envelope, and you watched it and then you mailed it back. But it was a much lower cost than Blockbuster. And by the time you get to 2002 and 2003, it's quite clear that the Blockbuster model is not working. But they continue to keep opening 100 new stores every year. Why? Because that's what they've always done. So you're now the CEO of Blockbuster. You come in and here's what you see. They're still making money. Their margins have dropped over the last, so you look at the margins, they've dropped. You're still making money. You're reinvesting about 26%, which is the new stores you're opening, and you're earning a return on capital of about 4% on those stores. Your cost of capital is 6.17%. You're almost 50% debt, 50% equity. So maybe you're on the other end of the spectrum. You have a little too much debt. So you come in, the company's in trouble. Its trend lines are gone. The revenues are dropping, but you're continuing to open stores. So if you come in as CEO of this company, you know what your first executive action is going to be the minute you walk in? Stop opening stores. You know how much pushback you get, right? This is what we always do. We've got these great opportunities still. We can grow out of trouble. But in this case, the biggest problem here is you're earning below your cost of capital. Every store you open is actually destroying your value. The value per share that I got with the status quo of this terrible investment policy is $5.13. If you make a very simple change of either assuming no reinvestment, zero reinvestment, or reinvesting at the cost of capital. I'm not even asking you to do miracles. Just take zero net present value projects. even if I leave everything else unchanged, the value per share that I get is $12.50. You've almost increased the value by 150% by just stopping this insane policy of continuing to grow. You know why I picked Blockbuster, right? Because Blockbuster was targeted by Carl Icahn around the time that I had this valuation. It was targeted for a very simple reason, which is, what are you guys doing? Why do you keep opening stores? Nobody's coming to these stores. Why do you keep doing that? You'd think you wouldn't need somebody from the outside to be telling you something that's obvious. But in this case, it was almost like the company was operating in denial. But already you can see with SAB, Miller, and Blockbuster, you're looking at a very different aspect of value. With Blockbuster, you might be focused on how do we cut costs and cut down in the number of stores. Growth here is going to be shrinking. Your best way to success might be to shut down the right stores and try to find a remaining business. And in 2004, maybe there was enough of a franchise name left with Blockbuster that they could have tried to do what Netflix did. It was still very early in this game and maybe had a chance of doing it, but that opportunity was fleeting. Once they let it go for 3 or 4 years, it became too late. So let's frame where we are. You can have a status quo value that reflects what the existing management could do to the company. So in the case of Blockbuster and SAB Miller, that's, it's $5 for Blockbuster, it's 106 euros. There is this value that you think you will get if you ran the company. That difference is the value of control, right? The value of control in the case of SAB Miller is about 20%. Very nice because it fits in with the rule of thumb, 106 to 126. The value of control in Blockbuster was 150%. Why is it greater? Because Blockbuster was a worstly managed company, worse run company than SAP. So the value of control is the difference between those two values. You don't have to do this for your company, but if you wanted to, you could make yourself CEO of whatever company you pick for your project and say, what would I change about this company? What would I do differently? It's kind of an exercise in freewheeling changes. You can be CEO for a minute with no consequences, change the numbers in a spreadsheet. Let's see what the value comes out to. That difference is value of control. But if you're thinking about paying for this company, you've got to multiply that value of control, that change in value you can get, by the probability that you can change the way the company is run. So let's say you value Facebook. You come up with $280 per share with Mark Zuckerberg running it. And you have all these great plans for what you will do with Facebook. And you come up with $400 per share. The value control is 120, right? But what is the probability that you can replace Mark Zuckerberg at Facebook? It's close to zero. Why? Because there's voting shares and non-voting shares, and there's no way you're going to overcome the fact that he controls 57% of voting rights. So what I'm going to do is take the change in value and multiply by the probability. And that probably is going to be a function of what kind of corporate governance structure does this company have? Where does it get traded? What can I do to change the management? Everything we think of in the context of corporate governance is going to come into play. So let's talk a little bit about this probability of management change, because it is something we have to think about whenever we think about investing in a badly managed company, because we're all often making a bet that something's going to change at this company. The first is to keep in mind that corporate governance rules do change over time. There are parts of the world where 20 years ago, I'd have said, just give up. If you have a badly managed company, nothing's going to change. Much of Europe, this was the case, 20 years ago. Today, things are starting to come through even in Europe, where you can challenge existing management change. You have activist investors in Europe. Countries like Brazil, you had corporate governance laws actually come into place that gave investors more power. The second is, for this to work, you need some big players who are willing to stand up and challenge management. The US, we've always had these players. They're not particularly popular, especially among CEOs, and you can see why. The Carl Icahns, the Bill Ackmans of the world, because they get in people's faces and they say rude things like, you're a terrible manager. What polite person says? But you can't be an activist and polite at the same time because you're challenging existing management. But here's something that could alter the probability very quickly. You know that when one company in a sector gets targeted in a hostile acquisition, the essence of a hostile acquisition is there's change in control. This is not a friendly merger. After a hostile merger, the existing management is removed. If you have one hostile acquisition, a company, the probability of change in every other company in that sector goes up almost instantaneously. Why? Because people look at that and say, that could happen to me. So when you think about estimating the probability of change, it's not easy to do, but it's something we implicitly do all the time. When you invest in a Blockbuster in 2005, whether you like it or not, you're making a bet on will there be change and what is the chance of it happening. There's actually a statistical technique called probit. I don't know whether you've ever seen it, but it looks like a regression. But here's the difference. In a regression, you have a dependent variable that could be debt ratios, PE ratios, remember all the choices? In a probit, your dependent variable is a 0-1 variable. In other words, let's suppose I want to estimate the probability that a company will be taken over. So here's what I do. I take the last 10 years of data. I divide the companies over those 10 years into companies that got taken over in a hostile acquisition and companies that weren't. The companies that were taken over, I put a number 1 for the so it's a dummy variable. It's 1 if it's taken over, 0 if it's not. That becomes my dependent variable. So think of it just like a regression. Then I say, hey, what is it that drives whether a company is going to get taken over? Maybe it's badly managed. I look at what your returns are as a company. Your return on capital is low, you're more likely to be taken over. I put that in as an independent variable. At the end of the process, I have an equation that looks like a regression equation. But when I put the numbers into the variables, instead of getting a predicted value for a debt ratio or PE ratio, I get a predicted probability that this company will be taken over based on history. So badly managed companies with small boards of directors and a terrible stock price performance are more likely to be taken over. I plug in your company's performance and directors and whatever I think into that regression. I get a predicted probability that your company will be taken over. That number could be 12%, 18%. In the case of Facebook, it might be 0%. Why? Because you're voting and non-voting shares, putting into the regression might reduce my chance of being taken over to 0. I'm going to argue that this control thing is not just in acquisitions. It's implicit in so many things in valuation that it's at least good to get comfortable with all of its different places. In hostile acquisitions, of course, the value control is what you're willing to pay up to acquire a badly managed company. Why? Because you think you can change the way the company is run. When you value a publicly traded company where you think there is a chance of change, let's say you think, I don't know whether any of you value Coles. You can value Coles right now and assume nothing changes and come up with a value per share. But Coles has also been targeted by a group of activist investors with a whole range of things that they want Coles to do. I would argue that what you're paying as a price for Coles would reflect both those values because it's like Hormel Foods. Remember, I valued it twice and took an expected value. If you're voting and non-voting shares, I'm going to argue that the value control is the player behind the scenes that explains why in some companies voting shares trade at a much bigger premium on non-voting shares and why in other companies there might be no premium at all. You know that Google voting and non-voting shares trade at roughly the same price. Facebook voting and non-voting shares trade at roughly the same price. You see, that makes no sense. It makes complete sense after you bring in the probability that you can actually change the companies and that probably is close to 0. So I'm going to use expected value control. And finally, private company valuations. There's something called a minority discount. You know what that is? I own a private company and I offer you 51% of my company. You're going to come up with the value, right? And then I offer you 49% of the same company. I'm going to argue that the value we pay for 49% is going to be dramatically lower than the value you pay for 51%. Why? Because with 51%, you get to run the company. With 49%, this almost destroyed the Mets. The Mets, as you know, any Mets fans, you know you have a new owner. And it's good to have a new owner because your old owner was one of the worst on the face of the earth. But one thing that almost stopped Steve Cohen from buying the Mets was the Wilpons, who were the owners, almost didn't want him to have a controlling stake. And he said, no, if I don't have a controlling stake, I'm not paying $1 billion plus for a team where you keep making the bad selections that you used to make and the bad managers you keep picking. Essentially, he was arguing and that's basically what a minority discount is. If you don't have control, and it's great in New York, just in the sports arena, you have the Knicks and the Mets, right? A history of badly managed. I mean, the Knicks should be the most valuable. They are the most valuable franchise in spite of having horrifically bad teams. Think of how much more they could be worth if somebody who actually knew basketball ran them, instead of the existing clowns that run the. So this is the case where if I offered you 49% for the Knicks, your answer should be no, thank you. I don't want that. But 51% of the Knicks, I'd pay a huge premium. So let's see how these play out in terms of the numbers. Let's start with hostile acquisitions first. Remember, for Blockbuster, I came up with a value of $5 per share with the status quo and $12.47 with somebody else running the company. The stock was actually trading at $9.50. So let's suppose I gave you those three numbers. Let's say this is your final exam question. I've given you a value for Blockbuster. Run as is, it's $5. Run by somebody who's much better, it's $12.50. The stock is trading at $9.50. And I said, can you estimate the probability that the market is assessing that change will happen? Can you? Because if you think about it, the $5 is the value with no change, the $12.50 is with change. You can solve for the probability, and it turns out that that probability works out to about 60%, 65%. Basically, the market, whenever it looks at a bad company, is already building in that expectation. But if it's a hostile acquisition, you say, look, I'm going to pay $12.97. Be careful. If you pay $12.97 to buy these shares, then what do you keep for yourself, right? You pay you do all the dirty work of fixing the company. I would assume you'd want some of that money. So if you computed $12.50 as your value per share, you don't want to pay the $12.50. You want to pay 10 or 9 or 8. In this case, you can't go lower than $9.50, obviously, because that's the stock price. But you got to be careful in hostile acquisitions, even when control is value, that you don't overpay for that control. But as I said, whenever you see a publicly traded company, implicit in the market price is an estimate of probability. In this case, for instance, with a $9.50 stock price, there's a 60% chance the market is assessing that change will come. But this was actually something that I computed after Carl Icahn had shown up. So I went back and looked at the price before Carl Icahn showed up. And before he showed up, the stock price was about $8 per share. When he showed up, what happened to the value? The value of the firm didn't change, but you know what changed? The minute Carl Icahn popped up in the news, people increased the probability that change will come. Because this is why when a company gets targeted by an activist investor, nothing has to change in terms of value. But the minute the activist investor pops up, you're going to see the price increase because people are reassessing the likelihood of change at that company and pushing up the price per share. So in a publicly traded firm, you could argue that what investors are pricing into the stock is an expected value of control. In other words, they're taking the value of the company as is, they're building in a likelihood that change will come and coming up with the value per share, because that's what prudent investors do. They build in expectations. So you can't just take the status quo value of your company, divide by the number of shares, and expect that value to be what you compare to the price. You have to value twice. I'm going to use that as my launching pad for thinking about what the voting and non-voting shares in the company are going to be worth. So here's what I'm going to do. I'm going to argue that as voting shareholders in a company, you get a chance to change the way a company's run. That's what you're getting. And with non-voting shareholders, you've got to be bystanders. Let me ask you an intuitive question. When is that right you have to change a company worth a lot? It's not when a company is well managed and well run. Because what do you want to change the company? It's going to be when it's badly managed and badly run. Do you see where I'm going? The better run a company is, the less value there is to a voting right, because it's not much you're going to change. The worse run a company becomes, the greater those voting rights. So badly run companies, you should expect to see voting shares traded at a much larger premium than non-voting shares. And I'm actually going to try to make this explicit by taking an extreme view. I'm going to argue that if you're the voting shareholder in a company, you control that entire expected value control. So as an example, here's a valuation I did of Embraer. Embraer is a Brazilian aerospace company. The status quo value I got was 12.5 billion reais. The optimal value that I got was 14.7 billion reais. The company had 242.5 million voting shares and 477 million non-voting shares. So my job is to assess the value. So basically I've got the value of equity. I'm now trying to decide how much to give to the voting shares and how much to the non-voting shares. So here's what I did. I took the status quo value, which is 12.5 billion, and divided by the total number of shares and said, if you're a non-voting shareholder, you're stuck with the status quo value. The value that I get is 17.38 reais per share. Then I took the expected value of control, which is there's a 20% chance of change, and divided by just the voting shares. So I'm taking that expected value of control and giving it all to the voting shareholders. The value that I got was $19.19. I am willing to pay about a 10% premium for the voting shares. Why? Because there is value from changing the way a company is run, and there is this 20% chance that control could change. You know what could they remove this premium in a hurry? If tomorrow the Brazilian government said nobody's going to be allowed to take over Embraer, they have a golden share, they can prevent it. That 20% becomes 0%. The voting shares and the non-voting shares will converge in value. The other thing that could cause the premium to disappear, if overnight Embraer fixed itself and became optimally run, the value of the voting shares will again converge in the non-voting shares, because now the value of change becomes zero. So already you can see why the Googles and the Facebooks trade at close. They're well-run companies where there's zero chance or very low chance of changing management. You already can see that this is not the kind of company where you're going to pay a huge amount. In contrast, you take a company like Viacom, which has Class A and Class B shares. It's a company with all kinds of internal problems that you might have to deal with. We do one final page before we end for the day. We talked about private company valuations, and there's a 51% versus 49%. It's very simple to compute what that minority discount is. Let's say you're looking at a private company. It's got a value of 2 million run optimally and 1.6 million run by the existing management. If I offer you 51% of this company, you're going to be willing to pay 51% of 2 million because you run the company, you get to change the company, which gives me 1.02 million. If I offer you 49% of this very same company, you're not going to use 2 million because you won't run the company. You're going to use the 1.6 million and 784,000. No wonder Steve Cohen almost backed out of the deal, because the Mets wanted him to pay the same price for a minority portion as a majority. And he said, no way. I want to be able to run this team because that's where the value comes from. The value control manifests in multiple places, and understanding it, I think, is critical. Even if you're not an M&A, if you're an average investor, if you're thinking as a manager, this is something that's always at play, at least behind the curtain. So I'll see you on Monday, because that's going to be a last day of class. And please do try to get those numbers in by Sunday night so I can use them for the Monday session. And I'll wrap up, there are about 8 pages left in the slides. I'll wrap them up in class on Monday when we do the last few pieces that are left of this packet. So you can leave this packet at home. I'll be sending you a closing presentation with the slides for Monday on Monday morning after I have your numbers. So I have to wait till the very last moment to put them together.
Professor, could I ask you a question, please, if you have
Sure.
a minute? Yeah, so after my unfortunate job in transfer pricing, I got an even more unfortunate job in private equity. I noticed there that when in a private company, the financier is the main shareholder. It's the marginal investor.
And also remember, private equity, not only is the financier the main shareholder, but they also get a management fee.
Yeah.
Often for running the company. So in a sense, you double dip, right? You get the management fee and you're the shareholder. So sometimes the management fee is big enough. You might not even care about your shareholder equity portion because you're going to collect your spoils. So I just set that up front because sometimes private equity people do things and you say, well, that makes no sense if their focus is on increasing value of equity. No, but continue. So
yeah. So in that case, for a private company, my marginal shareholder pretty much decides my cost of capital. Doesn't,
Not
don't they?
necessarily, right? If you're a private equity investor and you've taken a public company private, what's your end game? What's the
I want
definition
to
of
sell
success?
it again. I want to
You
sell it again
to a
and
public company, you want to
exit.
take it public. In other words, you never manage this company as a private company. It's almost like you're a custodian of a public company. And what you use is this 3 or 4 year window to make the company cosmetically, fundamentally better. So when you flip it back, you get a much higher value. So a private equity investor never has to think about a total beta. They have to be concerned about how diversified. And many of them have, in fact, removed the problem entirely because we're a KKR or a Blackstone. You know what you did, right? You went public yourself. So even though you're not diversified, you have this total beta risk, your investors are now diversified. They don't really care about that. So you never have to think about those holdings as private businesses because they're really not private business. They're public companies just held out of the limelight till they can be brought back public again.
Got it. Thank you.
Okay.